Two traders see almost the exact same breakout. Both enter. One catches a huge move. The other gets trapped almost instantly.
Two traders see almost the exact same breakout. Both enter. One catches a huge move and the other gets trapped almost instantly. Same pattern. So what did one trader see that the other missed? So most traders they follow something very simple. If price breaks the high and closes above it, that's a breakout. And if it breaks the high, leaves a wick and closes back underneath, that's a fake out. Simple, right? There's just one problem. A wick doesn't automatically means a fake out. And a candle closing above resistance doesn't guarantee continuation. Look at these two examples. Both break resistance. One fails, the other runs. If the breakout candle alone could tell us the answer, we would not need anything else. So the real question isn't, can I predict every fake out? You can't. The better question is, can I identify situations where the odds of a successful breakouts are better? And that's what we are going to investigate. So instead of taking one perfect looking chart, let's look at the pieces around the breakout. First, where is the breakout actually happening? Is it breaking an important level? Or is it just breaking some random candle from yesterday? Because not every high is equally important. Second, what is the market doing around this stock? A breakout in a strong market is not the same event as a breakout while the entire market is falling. Context matters, market regime matters. So a beautiful setup fighting a bad market has a very different probability than the same setup moving with the market. Third, who is participating? A price move with no meaningful increase in participation is different from a breakout where activity suddenly expands. But here's another trap. High volume doesn't automatically mean smart money. It simply tells us something changed and we need to understand that. Now let's make this more interesting. Take two stocks, both break resistance on the same day, but one has been outperforming the market, while the other has been quietly losing the strength. Same breakout, different context. That is where the relative strength becomes useful. So now we get to the part most breakout traders hate, waiting. The breakout happens, and instead of chasing the candle, we wait. If price comes back, test the old resistance, and buyers defend it, we now have something the original breakout candle did not give us, evidence.
The breakout happens. And instead of chasing the candle, we wait. And buyers defend it. We now have something the original breakout didn't give us, evidence.
Now let's just flip the idea. The price breaks above the resistance, but immediately falls back underneath. So instead of treating the wick as an automatic sell signal, watch what happens next. If price can't reclaim the level and sellers continue to control the move and push it down, the failed breakout becomes much more meaningful. But now comes the uncomfortable question. Do these things actually improve the odds? Or do they simply look good on chart after the fact? So for every breakout, we want to know 5 things. Where did it happen? What was the market doing? Was participation expanding? Was the stock showing relative strength? And most importantly, what happened after the breakout? And here's something very important to understand. None of these tells you what the market must do next. So a wick is not a prediction. A volume is not a prediction. A relative strength is not a prediction. Even a retest is not a guarantee. They are pieces of evidence. The goal isn't certainty. The goal is better decision making. So now, look at this chart. This is how most traders see a breakout. Price breaks the previous high and suddenly the move looks quite obvious. But look again. This is how we look at it at delta charts. We don't just look at the candles that broke out. We look at everything that led to it. the structure, the higher low, the breakout structure, and most importantly, the confluence, and finally the breakout. And when those conditions align, our chart changes. That green background is not just a prediction. It is our visual confirmation that the conditions we are watching have aligned finally. Because the breakout isn't the story, the breakout is the result of the story. And that's the difference between simply watching price and actually reading the chart. So now, can you predict a false breakout? No. And that's actually the point. You don't need to predict every fake out. You need to stop treating every breakout as equal. So the next time you see a breakout, don't ask, should I buy? Ask 5 better questions. Where is it happening? What is the market doing? Is participation expanding? Is the stock actually strong? And did the breakout prove itself?
Price breaks above resistance, but immediately falls back underneath. Instead of treating the wick as an automatic sell signal, watch what happens next.
Trading is full of rules, breakouts, fakeouts, indicator, patterns. But here's what we do differently at Delta Charts. We don't want you to blindly believe the rule. We want you to put the rule on trial. If you want trading explained with chart, data, and evidence, welcome to Delta Charts. And in the next episode, we test something traders have believed for years. Does RSI below 30 normally mean you buy?